There are quite a few stocks that have been crashing in the markets of late, and I'm going to focus on three of the bigger ones that are oversold with RSIs of less than 30 right now. One of the ones is Shell, Royal Dutch Shell. So the oil and gas company has an RSI of 27 right now. And the reason Shell is struggling is because there's concerns about oil prices going down. WTI hitting a 3-year low, bearish trader sentiment. So a lot of people expecting that oil prices are gonna go lower, especially with a possible recession happening potentially next year. So Shell trades at 12 times earnings, forward PE of 7.7. So it always trades at fairly low multiples just because of the uncertainty and volatility, because a lot depends on oil prices ultimately, because if oil prices are high, then the profits are going to be soaring. When they're not, then these earnings multiples are going to look a lot different. So Shell is still a pretty decent buy, just because it's a good hedge against inflation, even though in a recession might not do terribly well. But this is a stock that's generally a good long-term hold, and right now it's still up about 4% for the year. For the past 12 months, year to date, its returns are flat, so it's about where it started. Pays a decent dividend, 4.1%, so above the S&P 500 average, which is around 1.3%. So it's a good value stock, good dividend stock if you just want to hang on to it. It's going to be fairly safe. It might go down in the next several months if there's a recession, but overall, might not be a bad buy, especially because Shell hasn't gone oversold. Actually, this is the only time in the past 12 months that it's gone oversold, so it's a fairly rare occurrence for the stock, which is a good sign that potentially it's a good buying opportunity. So if you're a dividend investor, might be worth buying the stock right now. Next up, I've got PDD Holdings. So this is the company that owns Pinduoduo and Temu. And so it's an oversold with an RSI of around 28 right now. It's briefly dipped into oversold territory in the past, but generally not too deep, not too long. This is a bit longer than it has in the past. And the reason why is, their earnings numbers weren't that great, so it's down 29% due to a large correction. So one day. Third is their largest loss since listing on the Nasdaq. So after it failed to meet expectations. So big reason why is, even though the revenues have been up, the problem is it didn't meet analysts' expectations. And when it's it's a big growth stock like that, a lot depends on how fast the business is growing, and bit of an underwhelming performance last quarter, and that's why there's a bit of a sell-off. Now, if we look at the stock's valuation, we can see that the stock is heavily discounted. So 10 times earnings, 4 PE of less than 7. So, I mean, these are incredibly cheap multiples. But the big risk with PDD and really any Chinese stock, you'll see that they're trading at these low multiples just because there's always going to be that geopolitical risk. There's the uncertainty that the Chinese government might impose restrictions or somehow impact its growth potential. So a lot of investors are always hesitant with these types of stocks. Another reason that PDD could face some challenges is that in Washington they're looking at reforming this loophole for tariffs that Temu and other online Chinese retailers are taking advantage by having low-priced items. And so if that happens and tariffs go up for those products, then that means, Temu, it's low-cost, low-price goods might suddenly become more expensive, and it has less of an advantage and becomes less appealing to shoppers than, say, an Amazon, which might have the same items at more of a price. So based on those risks, I still wouldn't buy PDD Holdings, just because even though it looks like it's a cheap buy, this is what may be a bit of a value trap, just because there's still risk involved related to its exposure to China, and the Chinese economy is slowing down a little bit as well. So there's a bit more risk. So I think that one could dip a little further down. The third stock is Dollar Tree. So Dollar Tree well into oversold at an RSI of just under 20 right now, and it went as low as around 13. So I mean, this stock was heavily oversold, and it too reported earnings recently. It cut its forecast, and so went down 20%, and it was already struggling before then. But the problem is that people are concerned that low income shoppers are also struggling right now. Same store sales for Dollar Tree were just 0.7%. So it's a bit of a stock that you may have expected to do well in a recession or be a bit more versatile, but even it's proving that it's not doing all that well because even low income shoppers are struggling right now. So it's a bit of a risk for Dollar Tree. Dollar General's also been struggling for similar reasons, just because its customers are struggling, and with a recession on the way potentially next year, things can continue to get worse. Now, the one reason why I think Dollar Tree might be a bit of an underrated buy, though, is it's looking to sell Family Dollar. So this is a chain that hasn't been doing fairly well for Dollar Tree, and if it gets rid of that, then its operations get a bit leaner. It gets some cash flow into its operations, and that can make it a bit of a safer buy. Now, in terms of valuation, it's trading at 20 times earnings for PE of less than just under 12, which is a bit cheaper than Dollar General. So Dollar Tree is a bit of an intriguing buy. I think it's tempting just because of how low the stock is trading right now at about $65. And if we look at it historically, I mean, year to date, it's down 54%. It's at more than a 5-year low. The last time it was this low was about 2017. And meanwhile, the business has gotten bigger. So right now, there's been a bit of a steep sell-off. You can see most recently that is a really sharp sell-off right now. And that's why that RSI number is really, really low. So I think as long as you're willing to ride it out, because it could still be a tough time for the company heading into next year if there's a slowdown. But in the long run, Dollar Tree is rolling out more higher priced items, which can help with its margins, help with its profitability. And once its core customer starts doing better and economic conditions improve, I think this could quickly turn around and become a much better buy. So I think Dollar Tree is another stock that might be worth buying, even though it's been taking a beating lately.